Let's learn how to produce the cost of goods manufactured statement. Recall that manufacturing costs, also called product costs, are the cost of converting raw materials into finished goods. These include direct materials, direct labor, and manufacturing overhead. We then have to think how these costs flow into the production process. To produce a product, we start with direct materials, the raw materials that are used to produce the product during the manufacturing process. These costs can be physically and directly traced to the product being produced. For example, the flour, sugar, eggs, milk, butter, and other ingredients required for manufacturing a cake. We then add in direct labor, which is the cost of the workers who convert the raw materials into the finished goods, and whose work is directly traceable to the production of the product. The baker, for example, who bakes the cake would be categorized as direct labor. Finally, we add in manufacturing overhead costs to the cost of the product. Manufacturing overhead are the costs which are indirectly associated with manufacturing a product. This includes things like indirect materials, indirect labor, depreciation on factory and equipment, insurance, property taxes, and maintenance on the factory facilities. All of these costs are related to the manufacturing process and must therefore be included in the cost of the product. These are the three manufacturing costs. As a product is being manufactured, all three of these costs are transferred into work in process inventory, WIP for short. It can also be called work in progress. This is a current asset inventory account on the balance sheet. Once the manufacturing process is complete and the goods are finished, the costs are transferred from WIP inventory into finished goods inventory. This is also a current asset inventory account on the balance sheet. Once the finished goods are sold, they are transferred out of the finished goods inventory into the cost of goods sold, which is an expense account on the income statement. What we need to be able to calculate is the cost of goods manufactured, the cost of all the goods which are finished during the period and are ready to be moved into finished goods from work in process inventory. We need the total cost of the products which have been completed and are ready for sale. This is the amount which will be transferred from the WIP inventory into the finished goods inventory account. But why else do we need to determine the cost of goods manufactured? This cost is required to calculate the cost of goods sold, the expense on the income statement. We've already covered the cost of goods sold statement in a previous video, but as a reminder, here's the statement again. Note that we start with the opening finished goods inventory, also called beginning finished goods inventory. We then add in the cost of goods manufactured to get the cost of goods available for sale, the total value of all the goods which are available to sell to the customer throughout the year. We then deduct the ending or closing finished goods inventory, the inventory which, at the end of the period, is still sitting on the shelf ready to sell to customers in the future. We get this amount from the balance sheet, current assets. The sum is equal to the cost of goods sold, which is placed on the income statement as an expense. This is the cost of all goods which have been sold to customers during the period. So, to calculate the cost of goods sold, we need to have the cost of goods manufactured, and the cost of goods manufactured uses your understanding of the costs that are included in product costs, direct materials, direct labor, and manufacturing overhead. The easiest way to demonstrate the calculation of the cost of goods manufactured is to use an example. ABC Manufacturing Limited is a manufacturing company. At the end of the second period, the company had the following information available with regards to their operations. Raw material inventory opening, $4,000. Raw material inventory closing, $7,600. Work in process opening, $32,000. Work in process closing, $28,000. Finished goods opening, $43,000. Finished goods closing, $69,000. Raw materials purchased, $92,000. Depreciation factory, $35,000. Sales commission, $70,000. Administrative expenses, $132,000. Direct labor, $148,000. Factory supervisor salary, $14,000. Insurance factory building, $13,000. Factory machinery rent, $28,000. Property taxes factory, $11,000. Sales net, $692,900. Indirect labor, $8,000. Utilities factory, $19,000. Delivery expense, $42,000. And indirect materials, $6,000. produce a cost of goods manufactured statement, a cost of goods sold statement, and an income statement for ABC Manufacturing Limited. Now that we have all of this information, what do we do first? Step 1 is to categorize all of the items into cost categories. The first two categories are product costs and period costs. For each product cost, we then have to divide into one of three categories: direct materials, denoted as DM, direct labor, DL, and manufacturing overhead, MOH. Recall the manufacturing overhead are all the indirect costs related to the production of the product. Remember also that period costs are all the costs which are not product costs. We'll denote these as PC. Also, note that some of the information produced will not fit into any of the categories. For these items, we'll use our professional judgment to categorize them. It is possible that they don't belong in any category at all. Let's get started. I've added additional columns so we can categorize all of the costs. Raw materials inventory opening and raw materials inventory closing relate to one account at two different periods of time. Both of them relate to direct materials, so we'll denote them as DM. We then see the same period of time for work in process, with an opening and a closing. Although we need these accounts on the statement of cost of goods manufactured, they include all three product costs: direct material, direct labor, and manufacturing overhead, so we leave these blank. Next, we see finished goods, opening and closing. These items belong in the cost of goods sold statement to calculate the cost of goods sold, so we'll leave these blank for now too. Raw materials purchased is part of direct materials, so we'll denote it with a DM. Depreciation factory is an indirect cost of producing a product. After all, we can't produce a product without equipment, and depreciation is the cost of that equipment's use. It's part of manufacturing overhead because the cost can't be directly traced to the product. MOH. Sales commission is the commission that is paid to salespeople when they sell products to stores. This has nothing to do with the factory or production, so this is a period cost. PC. Administrative expenses are part of the cost of running the business and have nothing to do with production. Therefore, it's a period cost. PC. Direct labor is pretty straightforward. It's a product cost. DL. Factory supervisor's salary is an indirect cost which can't be traced directly to the product. It is therefore part of manufacturing overhead, MOH. Insurance factory building is the same, an indirect cost which is part of manufacturing overhead, MOH. Factory machinery rent is also an indirect product cost because we can't trace it directly to the product, but it is part of production, so it's a manufacturing overhead cost, MOH. Property taxes factory is the same, indirect manufacturing overhead, MOH. Sales net is not a product cost or a period cost. In fact, it's a revenue on the income statement, so let's use R to denote it as revenue. Indirect labor is a product cost, but because it's indirect, it's part of manufacturing overhead, so MOH. Utilities factory is again a product cost, indirect, since it can't be traced directly, so part of manufacturing overhead, MOH. Delivery expense has nothing to do with production, but everything to do with sales. Therefore, it's a period cost, PC. Finally, indirect materials are indirect, part of the manufacturing overhead, denoted MOH. Done. We've now categorized all of the items into cost categories and can move forward with step 2, calculate the direct materials used in production. But why? Because direct materials are part of the cost of manufacturing a product, and we have to determine how much of the materials are actually used in production during the period. Keep in mind that I'm going to be using the information from our listing, so make sure you keep it handy so you know where all the numbers are coming from. We'll start with raw materials inventory, opening $4,000, which we got from the listing. We then add in raw materials purchased, $92,000. This is equal to the total raw materials available for use during the period. $4,000 plus $92,000 equals $96,000. Deduct the raw material inventory closing, which is the raw materials still sitting on the shelf at the end of the period, ready to be used next year. From the listing, this is $7,600. $96,000 minus $7,600 is equal to $88,400. This is the amount of the direct material which has gone into the production process during the period. We now move on to step 3. Use this information to create the statement of cost of goods manufactured for the period. Note that again, we'll regularly refer to the listing, so keep it handy. We'll start with the name of the company, ABC Manufacturing Limited, then the name of the statement, Statement of Cost of Goods Manufactured, and finally the date, year ended December 31st, 2000XX, which is what we're going to use for this example. We'll start with direct materials, which we calculated was $88,400. Again, these are the direct materials which were used in the production process during the period. And we're going to place it on the first line of the Statement of Cost of Goods Manufactured, $88,400. We then add direct labor, which we get from our listing, $148,000. This is one of the easiest costs to categorize since it's always listed as a standalone item called direct labor. Added into our statement, $148,000. The last product cost is, of course, manufacturing overhead, for which we need a heading. This requires a heading because it's made up of multiple items from the listing, and they must all be listed separately. Remember that all the items denoted as MOH are all indirect costs of the production process, which are difficult or impossible to trace directly to the product. We are going to take every single one denoted with MOH, and we're going to add the listing to our Statement of Cost of Goods Manufactured. There's no required order for the manufacturing overhead items, so I'm simply going to place them in the order that I saw on the listing. That will be depreciation factory, $35,000. Factory supervisor's salary, $14,000. Insurance, factory building, $13,000. Factory machinery rent, $28,000. Property taxes, factory, $11,000. Indirect labor, $8,000. Utilities, factory, $19,000. And finally, indirect materials, $6,000. The sum of all these items is the total of manufacturing overhead, $134,000. We now have to add all three product costs together. Direct materials, $88,400, direct labor, $148,000, and manufacturing overhead, $134,000. The total manufacturing cost for the period is $370,400. This represents all of the product costs which we added into the production process during the period. We now have to add in the work in process opening, which of course is from our listing, $32,000. This is the amount of direct materials, direct labor, and manufacturing overhead from the products which were unfinished at the beginning of the period. This cost must be added in because these are the products which would have been finished first at the beginning of the year. They are part of the products which are moved into finished goods, so we add in $32,000. We then deduct the products which, at the end of this period, are still unfinished and can't be transferred into finished goods. These items are still in the production process, called work in process closing. From our listing, we know this amount is $28,000. So we deduct this on the Statement of Goods Manufactured, $28,000. Remember, these products are unfinished at the end of the year and therefore can't be included in the cost of goods manufactured since they are incomplete. The final number is the cost of goods manufactured, all of the goods which finish the manufacturing process during the year. $370,400 plus $32,000 less $28,000 is equal to $374,400. This is the amount that will be transferred into finished goods. This was our goal from the start, to figure out the total cost of all the finished goods produced during the period. So remember, we need to use this cost of goods manufactured in the cost of goods sold statement. Let's produce one for ABC Manufacturing Limited. We start with the company name, ABC Manufacturing Limited, the name of the statement, cost of goods sold statement, and the date, year ended December 31st, 2000XX. Notice that this date is the same as the date we saw on the cost of goods manufactured statement. We then start with the opening or beginning finished goods inventory, which we get from our listing, $43,000. This is the finished goods which were on the shelf at the start of the period, equal to the ending finished goods inventory from the prior period. Remember, these at the beginning of the year were unsold. It's the first item in our cost of goods sold statement, $43,000. We now add the cost of goods manufactured, which of course we get from the cost of goods manufactured statement, which we just finished, $374,400. We're going to transfer that back into our cost of goods sold statement, $374,400. This is all the inventory which has completed the production process during the period and is ready for sale to the customer. Added together, this equals the cost of goods available for sale. All the goods, including the opening finished goods inventory, which was available for sale to customers during the year. $43,000 plus $374,400 equals $417,400. We now have to deduct the closing, also called the ending finished goods inventory. Where do we get this amount? Well, we get it from the current assets section of the balance sheet. This is the finished goods inventory, which is as yet unsold at the end of the year, still sitting on the shelf ready for sale next year. We can also get it from our listing, finished goods closing $69,000. We place that in the cost of goods sold statement as a deduction from the cost of goods available for sale. Deducting it from the cost of goods available for sale, $417,400 minus $69,000, which is equal to the cost of goods sold of $348,400. This is the value of all the inventory that is sold during the period, which is the amount in the income statement. So let's create one for ABC Manufacturing Limited. We'll start with the name of the company, ABC Manufacturing Limited, name of the statement, income statement, and the date, year ended December 31st, 2000XX. Notice again that this date is the same date we saw on the cost of goods manufactured statement and the cost of goods sold statement. The first item on the income statement is always sales or sales revenue, which we take from our listing, $692,900, and transfer into the income statement, $692,900. We then take the cost of goods sold, which we take from the cost of goods sold statement, which we calculated as $348,400. This is the amount of inventory which has been sold during the period to customers, and the number we need on the income statement. Cost of goods sold, $348,400. We then calculate the gross profit, also called the gross margin, which is sales revenue of $692,900, less the cost of goods sold of $348,400, which is equal to a gross profit of $344,500. We now have a heading called Operating Expenses. Here we're going to use all of our period costs from the listing. There is no required order for these, so I'm just going to put them in the order they show up on the listing. Sales commission, $70,000. Admin expense, $132,000. Delivery expense, $42,000. Total operating expenses are therefore $244,000, the sum of all the period costs. We deduct the total operating expenses from our gross profit, $344,500 minus $244,000 is equal to income before income taxes of $100,500. Note that this is also called operating income in management accounting. This is the income statement for ABC Manufacturing Limited. You have now been introduced to the statement of cost of goods manufactured, the cost of goods sold statement, and the income statement for ABC Manufacturing Limited. Understanding the flow of costs in a manufacturing environment are concepts that you are going to need to use as you move through any management accounting course. Make sure you practice and master all these concepts as you move forward. As always, thanks so much for watching, and I'll see you in a future video.